Hey everyone, welcome back to Corporate Decoder, the place where we decode those cryptic corporate filings to uncover the real story. And let me tell you, today's filing is full of surprises, especially when it comes to a company potentially changing hands in a big way. Before we dive in, if you love getting direct insights from these official documents without the corporate jargon, hit that subscribe button and join our growing community on Discord. The link is in the description below. VYNE Therapeutics Incorporated has just dropped a Form 8K, and it looks like they are entering into a pretty significant agreement that could reshape the company as we know it. They are signing a deal to merge with Yarrow Bioscience Incorporated. This isn't just a small tweak, it is a major power shift, and we're going to break down what it means for shareholders and the future of VYNE. So, the earliest event we're talking about here happened on the 17th of December 2025. This is when VYNE Therapeutics Incorporated and Yarrow Bioscience Incorporated, along with a subsidiary of VYNE called Yellow Merger Subcorp, officially entered into an agreement and plan of merger and reorganization. This document outlines the terms of their coming together. Let's talk about the companies involved. VYNE Therapeutics Incorporated is the registrant, the one filing this report. They are based in Delaware, and their incorporation file number is 001-38356. Their IRS employer identification number is 45 to 3,757,789. We also see their principal executive offices listed as PO Box 125, Stewartsville, New Jersey, with a zip code of 08886. Their main phone number is 800-775-7936. Now, looking at what is registered under the company, their common stock, which has a par value of $0.0001, is traded under the symbol VYNE on the NASDAQ stock market LLC. This is important because any changes to this listing will be a big deal. The meat of this filing is really about this merger agreement. What is happening here is that Yellow Merger Subcorp, a wholly owned subsidiary of VYNE, will merge with and into Yarrow Bioscience. Yarrow will then continue as a wholly owned subsidiary of VYNE, and it will be the company that survives the merger. This whole process is designed to qualify as a tax-free reorganization under the Federal Income Tax Code, which is usually good for everyone involved. So, what does this merger actually mean for the shareholders? Subject to the terms of the agreement, at the time the merger becomes official, called the effective time, Yarrow Capital stock will be converted into VYNE common stock. The amount of VYNE stock each Yarrow shareholder receives will be calculated based on a specific exchange ratio, which is detailed in the merger agreement. This also affects Yarrow's options and warrants. Any outstanding options to buy Yarrow common stock will become options to buy VYNE common stock, and all their warrants will similarly be converted into warrants to purchase VYNE stock, with adjustments made as per the agreement. Interestingly, before the merger is final, VYNE's board plans to speed up the vesting of all their own stock options and restricted stock units. Now, here is a key detail. Any company options where the exercise price is higher than the 5-day average closing price of VYNE stock, these are called in-the-money company options, will actually be cancelled at the effective time. The holders of these options will receive cash equal to the difference between the stock price and the exercise price. Options with an exercise price higher than the stock price will just be cancelled with no payment. Immediately before the merger, holders of accelerated restricted stock units will get shares of VYNE common stock for any vested and unsettled units. Now, this is a huge part of the story, ownership. After the merger and factoring in some financing that is happening, it is expected that shareholders of Yarrow will own about 97% of the newly combined company. Shareholders of VYNE, who were around before the merger, they'll likely own only about 3%. This tells you that Yarrow is essentially acquiring VYNE, or at least bringing a much larger stake to the table. There is also a mechanism for adjustments. If VYNE's net cash at the closing of the merger is less than 0, the exchange ratio and the ownership percentages will be adjusted. This means VYNE's financial health at the crucial moment will directly impact how much Yarrow gets relative to what VYNE shareholders keep. And here is something for existing VYNE shareholders to consider. Before the merger closes, VYNE expects to pay out a pre-closing dividend to its current shareholders. This dividend is estimated to be between $14.5 million and $16.5 million in total. This is a cash payout to reward existing shareholders before the big ownership change. For this to happen, VYNE needs shareholder approval for a few key things. They need approval to issue a significant number of new shares, more than 20% of what is currently outstanding, which is a NASDAQ rule trigger. They also need approval for the change of control itself, as per NASDAQ rules. And importantly, they plan to do a reverse stock split. This is usually done to boost the stock price to meet the $1 minimum bid price requirement on NASDAQ, which is a common compliance measure for companies facing price pressures. Both companies are agreeing to standard terms in this deal. They'll both work reasonably hard to get their shareholders to approve the merger. They've also agreed not to look for other acquisition offers, meaning they are committed to this deal. VYNE is obligated to try its best to keep its stock listed on NASDAQ and to get the newly issued shares approved for listing as well. Plus, VYNE has to file a registration statement with the CC to officially register the shares that will be issued in the merger. There are several conditions that must be met before this merger is finalized. We already mentioned that VYNE shareholders need to approve certain matters. Yarrow shareholders also need to approve the deal. NASDAQ has to give its green light to the listing application for the new shares, and that registration statement we just talked about needs to become effective. Both sides also have typical conditions, like making sure the other party's promises about their business are accurate and that they're fulfilling their obligations. Now, what if things fall apart? The merger agreement does include specific ways both companies can walk away from the deal. If that happens under certain circumstances, the company that breaks the deal might have to pay the other a termination fee of $1 million. The good news is that the boards of directors for both VYNE and Yarrow have approved this deal. They are expecting the merger to be completed in the second quarter of 2026. But remember, this is still subject to all those closing conditions we discussed, like getting shareholder approval from both sides. Here is an indication of who is really taking the reins. At the merger's effective time, the board of directors for the combined company will be decided by Yarrow, and all members will be chosen by Yarrow. Similarly, the executive officers of the company will also be determined by Yarrow. This strongly suggests Yarrow is the driving force behind this combined entity. Now, let's look at the financial side of things that are happening alongside this merger. Yarrow has just completed a series of preferred stock sale. They raised approximately $100 million from institutional and accredited investors in this private placement. This funding likely supports their operations and their part in this upcoming merger. On top of that, there is something called a pre-closing financing. In conjunction with the merger agreement, investors have also agreed to purchase what are called PIPE securities, which include pre-closing shares of Yarrow Capital stock and pre-funded warrants. The total amount raised in this private placement is also approximately $100 million. This financing is expected to close around the same time as the merger. These investors in the pre-closing financing will also get a registration rights agreement. This agreement basically means that VYNE will have to help them register and sell the company common stock that they'll receive after the merger, and also any stock they get from exercising their pre-funded warrants later on. This ensures their investment can be made liquid. To further solidify this deal, there are support agreements and lock-up agreements. Key directors and officers of VYNE, who hold about 3% of the company's shares, have signed agreements to vote their shares in favor of the merger and against any alternative offers. Similarly, almost all Yarrow shareholders, representing 100% of Yarrow Capital stock, have also committed to voting in favor of the merger. Furthermore, certain top executives and directors from both companies have signed lock-up agreements. This means for 180 days after the merger closes, they are restricted from selling their shares of company common stock, which is a pretty standard way to prevent immediate selling pressure right after a big deal. The PIPE securities, those shares and warrants in the pre-closing financing, were offered and sold without being registered under the Securities Act of 1933. This was done under an exemption that allows for transactions with accredited investors who are buying for investment purposes, not for immediate resale to the public. This item is pretty straightforward in this context. Given that Yarrow shareholders will own about 97% of the combined company, this merger clearly represents a change in control of VYNE. The information from item 1.01, which we've been discussing, details this change. This section often covers leadership changes. As we noted earlier, Yarrow will be determining the new board members and executive officers. So, while not explicitly detailed here as a departure or appointment, it is clear that significant leadership changes are expected driven by Yarrow's decisions. VYNE and Yarrow also issued a joint press release on the 17th of December announcing this merger agreement. They also held a conference call to discuss the merger in more detail on the same day. This filing, like most, contains something called forward-looking statements. These are essentially statements about what the companies expect to happen in the future, things like the timing and completion of the merger, how the combined company will be structured, future financial performance, and product development. They use words like anticipate, believe, expect, and will to talk about these future possibilities. However, it is crucial to remember that these are just expectations. They are subject to many risks and uncertainties. This includes the possibility that the merger might not get approved, that financing could fall through, or that the combined company might not achieve its expected benefits. They also mentioned that the company's ability to advance its product candidates, get regulatory approvals, and compete in the market are all potential challenges. The filing warns that actual results could differ significantly from these forward-looking statements. This part is a legal disclaimer. It is important to understand that this report is not an offer to sell any securities or a solicitation to buy any securities. It is simply providing information about the proposed transaction. This is a critical statement from the SEC. It means that just because this report is filed, it doesn't mean the Securities and Exchange Commission or any state securities commission has endorsed the securities involved or confirmed the truthfulness or completeness of this filing. It is up to investors to do their own due diligence. The companies intend to file more documents with the SEC, including a registration statement on Form S-4. This document will contain a proxy statement and prospectus, which will offer more detailed information about the merger. Investors are strongly urged to read these documents carefully when they become available, as they will contain vital information about the company, Yarrow, the merger, and related matters. Finally, this section lists all the exhibits attached to this report. These are the actual legal documents that support the information presented in the filing, like the merger agreement itself and various forms of support and lockup agreements. The most important exhibit here is Exhibit 2.1, which is the actual agreement and plan of merger and reorganization dated the 17th of December 2025 between VYNE Therapeutics Incorporated, Yarrow Bioscience Incorporated, and Yellow Merger Subcorp. Now let's step back and look at this whole situation. What is the story here? VYNE Therapeutics seems to be at a crossroads. They are entering a merger where the balance of power is heavily shifted towards Yarrow Bioscience. Yarrow is essentially acquiring VYNE, bringing in significant funding of around $200 million through its series of financing and a concurrent pre-closing financing. This suggests Yarrow has substantial backing and a clear strategic vision. For existing VYNE shareholders, the situation is complex. They'll receive a cash dividend before the merger, which is a nice gesture. However, their ownership stake in the combined entity will be drastically reduced to about 3%. This implies that VYNE's current market value and future prospects, from Yarrow's perspective, are not as significant as Yarrow's own assets and potential. The reverse stock split plan also signals that VYNE has been struggling with its stock price, a common sign of underlying business challenges or market sentiment issues. The risks are pretty clear. The success of this merger hinges on many factors, including shareholder approval and Nasdaq's nod. If these conditions aren't met, the deal could fall apart and the termination fee is a real possibility. Furthermore, the forward-looking statements highlight that the combined company's future success is far from guaranteed. They need to navigate regulatory hurdles, product development, and market competition, all while managing new leadership and a drastically altered ownership structure. In essence, this filing signals a significant shift for VYNE. It looks like Yarrow is using VYNE as a vehicle for its own strategic goals, bringing in substantial capital and asserting control. For VYNE investors, it is crucial to weigh the immediate cash dividend against the very diluted future ownership. It is a move that suggests Yarrow sees a greater opportunity, and VYNE's current assets or market position are seen as more valuable as a stepping stone rather than a standalone entity. Alright, that is our breakdown of VYNE Therapeutics Inc. Recent filing. What is your take on this merger and what it means for the future? Do you think this is a smart move for Yarrow and a decent exit for VYNE shareholders? Or are there hidden dangers? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord community linked in the description. Thanks for watching, and we'll see you in the next one.